At a certain stage in my trading career, I realized that the most significant changes do not take place on the chart, but in the trader's mind. The market may remain the same, and the instruments may not change for years, but one's perception of what is happening gradually becomes completely different. I used to view every trade as a separate event. If a position made a profit, the day was considered a success. If it was closed at a loss, I felt as though I'd made a mistake. This approach created constant emotional swings, which prevented me from assessing the results objectively. Over time, I came to realize that a single trade means practically nothing. What matters far more is the sequence of decisions over the long term. That is precisely why, today, I try to assess not an individual result, but the quality of how I execute my system. This principle is particularly evident in the equity market. There are periods when even the strongest companies come under pressure due to the general sentiment amongst investors. At such times, it is easy to start doubting one's own analysis. However, the market is under no obligation to validate an idea immediately after a position is opened. I remember a period when the technology sector was under selling pressure for several weeks running. The news backdrop was becoming increasingly negative. Analysts were revising their forecasts downwards, and many market participants were looking exclusively for short positions. But amidst the general decline, there were companies that stopped hitting new lows and began to show resilience. It was then that, for the first time, I consciously focused not on what the market as a whole was saying, but on what a specific security was showing. Gradually, it was precisely these securities that became the leaders of the recovery as the general sentiment began to improve. Equally interesting observations arise when trading commodities. Oil and gold often go through periods of high uncertainty, when prices can move for weeks without a clear direction. For many traders, such periods are a source of frustration. But over time, I began to view them differently. The longer the market remains in a state of equilibrium, the more closely I try to observe changes in market participants' behavior. Very often, strong price movements begin precisely after prolonged phases of uncertainty, when most people have stopped expecting any further developments. My attitude towards mistakes has changed significantly. Previously, any unsuccessful trade was seen as something negative. Now, I increasingly view it as a source of information. Sometimes a loss can tell you more about the market than a profitable position. I suppose this has been one of the main changes over recent years. I've stopped seeing trading as a competition where you constantly have to prove you're right. Today, the market seems more like a process of continuous learning, where the important thing isn't to be perfect, but to retain the ability to adapt and draw conclusions. And the further I go down this path, the more I realize that long-term success is built not on individual successful trades, but on the ability to maintain a consistent way of thinking, regardless of what is happening in the market.